At the beginning of October, the U.S. Congress once again failed to approve the budget on time, resulting in a government shutdown on October 1st. Hundreds of thousands of federal employees were furloughed without pay, and official government economic statistics ceased to be published. This triggered panic in the markets. Now, however, it looks like the markets could stabilize. Will the longest U.S. government shutdown in history finally come to an end? The current shutdown has dragged on into November, making it the longest in U.S. history. The situation only eased yesterday when the Senate approved temporary funding for suspended services. During the shutdown, the S&P 500 index tended to move sideways. A more significant increase occurred only with the hint of an end to the shutdown. Yesterday, the leading U.S. stock index rose by 1.56%, significantly offsetting the losses from Friday's session. The market also reacted to expectations of the resumption of long-blocked macroeconomic data, such as labor market and industry reports. Until now, investors had not received any official reports and had to settle for research from private agencies. Even the central bank could not predict the economic environment without this data, so its resumption is certainly a step in the right direction. The current budget stalemate was broken in the Senate, which approved a procedural vote on further funding adjustments on the night of November 10th. The new proposal extends funding for government institutions until January 30th next year and includes 3 full-fledged budget packages. President Donald Trump commented that it seems we are nearing the end of the shutdown, although the agreement would, among other things, allow the government to reopen by January 30th. It does not include any immediate vote on extending healthcare subsidies, which Democrats had previously demanded. So what happens to stock prices before, during, and after a shutdown? Let's compare the impact of the shutdown on the S&P 500 with previous crisis situations. The 1995 to 1996 shutdown under President Clinton lasted 21 days. The S&P 500 index remained virtually unchanged, gaining only 0.03%. Similarly, volatility remained low, and the market was calm. However, in the following month, the index rose by almost 4%. The 2013 shutdown under President Obama lasted 16 days. During the shutdown, the index rose by 2.33%. It strengthened mainly thanks to a stable economy and favorable interest rate conditions. The market risk model showed a slight increase in volatility, the highest in the history of shutdowns. After the shutdown ended, stocks rose even further. In the following weeks, they added 4.5%. The 2018 to 2019 shutdown under President Trump lasted 35 days. This longest shutdown to date, as the current one is still not officially over, lasted 35 days and, paradoxically, the markets responded with significant growth. The S&P 500 index rose by 10.07% during the shutdown. This was mainly due to looser monetary conditions. The Fed signaled a rate cut, which pushed the index up. This shutdown was caused by a dispute over funding for the construction of a wall between the U.S. and Mexico. After the shutdown ended, the index continued to rise by another 5%. Historical data confirm that the S&P 500 usually stagnates or grows slightly during shutdowns. Overall, 10 of the 13 previous shutdowns brought at least a slightly positive return. The largest decline of 2.2% occurred during a 2-day interruption in 1984. But why does the market react illogically to shutdowns at first glance? Markets view shutdowns as a temporary problem, not a permanent economic crisis. Key indicators such as consumption, corporate profits, and interest rates remain unchanged or are only slightly affected in the short term. Most importantly, there is an expectation that the government shutdown will end soon. As economist Philip Shaw points out, the market is usually ready for further growth after a shutdown ends. You can find out which stocks could benefit from further growth in the Fair Price Index on Bulios, which tells you which companies are currently trading below their fair price and which have the highest potential. If you sign up using the link below the video, you will also receive an exclusive 10% discount on membership forever. 2 effects are important in shutdowns. First, a data vacuum is created during the shutdown. Key statistics such as the unemployment rate and industrial production are no longer published. And second, government spending declines. The first effect means that markets have no new information and are simply waiting, which reduces volatility. The second effect reduces GDP, but only temporarily. According to estimates, a 6-week shutdown could reduce quarterly GDP growth by around 0.4 to 1%. In reality, businesses, households, and the central bank know that this is a temporary paralysis, followed by a recovery. Psychologically, the shutdown acts as a brake on confidence. Analysts point out that the funding blockade reduces consumer and business confidence and creates uncertainty. But as soon as promises of an end to the shutdown were made, the accumulated tension evaporated from the market, sending stock prices higher. History shows that the market quickly absorbs these macroeconomic and psychological effects. Of the 21 previous shutdowns, the S&P index rose in 12 cases, with an average return of 0.1%. After the shutdown ended, it usually strengthened more strongly. For example, in the year after the shutdown between 2018 and 2019, the index added 26.2%, and after the 2013 shutdown, it grew by 19.7%. Although the current shutdown has reduced confidence in the short term, it has not caused any major damage to the S&P 500 index. In the coming days, barring any sudden problems, we should see the shutdown finally come to an end, which could potentially open the door to further stock market growth.